Are we live? Are we live? Hey everybody, Real Estate Ninja here. I hope you're doing well. We're gonna be talking today about commercial mortgage-backed securities. We're gonna be talking about a company named Arbor that's in trouble because of multi-family issues. I'm actually out here in Reno, Nevada right now, and we're across from a massive, absolutely massive complex of multifamily properties. This one's called Halcyon Apartments. They're touting themselves as luxury apartments. It's massive. You can see that all of the buildings being constructed are in the near completion on the main drag, right? And then you can see over here towards the back, these are a little behind, right? Now here's the deal. How long has this property been under development? Well, it's been probably since conception, at least a couple of years. When financing was taken out for a property like this, the clock started ticking. See, because commercial properties and debt that's tied to commercial has 5 years before it has to be redone, renewed, refinanced. And a lot of companies, the one we're going to talk about right now, Arbor, is finding themselves in trouble. And let's dive right into it, because I think it's very important that people understand Reno, Nevada right now has gone through such a boom, it's insane. They have been a part of the mass migration of Californians leaving California, and they have seen a real estate boom like they have never seen before. And I believe that's going to lead to a massive crash in the values of properties over the next couple of years in this area, Reno. So check this out. This story, let me get it, sorry. Story is out of The Real Deal. It's entitled "The Worst of the Worst. Arbor Realty is in trouble over multifamily lending." It says, as multifamily syndicators face mounting distress, their favorite lender could be in deep trouble. Let me stop. When we talk about syndication, I want you to understand the syndicators make money only when they're buying and selling, and they actually take money too when they're managing the property. But that's not, a lot of syndicators take a percentage just to manage the managers, the property managers. They're not property management companies, they're syndicators. They take money, they take a cut of the amount of the property when they go and buy one. They take a cut when they sell it, and they take a cut to manage the management company, okay? We're gonna see a lot of syndication companies go down in the next year because of lending problems. It says Arbor Realty Trust has long been a prominent player in multifamily lending, but the firm's heavy exposure to the industry and its reliance on the floating rate, CLO, or collateralized loan obligations, backed debt, has landed it in trouble. The Real Deal's Deconstruct podcast sat down with Gabriel Bernard, a researcher at short seller Visori Research, to shed light on Arbor's precarious situation. It says Arbor has made a name for itself in recent years by providing floating rate bridge loans to multifamily syndicators. These syndicators, many of them inexperienced investors, focused on buying transitional properties that needed renovations and rehabilitations, after which they could increase rents. At 0% interest rates, it's very hard to lose money doing that, Bernard noted. But the problem with all of these bridge loans is that, especially in Arbor's case, substantially all of them are a floating rate. The rising interest rates have left many syndicators underwater, thanks in part to slowing rent growth and increased renovation costs. Now, remember, rents have been going up ever since the pandemic. However, they have now started to dip as more and more of these buildings come online, and you can see these ones are close to completion. These ones are a little farther away. Every time a building like this comes online, there's now more inventory in a town or a city. It's very simple. And actually, what most people don't pay attention to, because they talk about a housing crisis, there has been an absolute explosion in the construction of multifamily properties since the Great Recession like we have really never seen in the last 50 years. A lot of people talk about homes, how there's less single family homes being built than what we saw in the lead up to the great financial crisis. That is true. However, I want to remind people that those homes didn't vanish, didn't all burn up. A tornado didn't come and destroy them. So every year there are more homes and there are more apartment buildings being built. We have way more inventory today than we did before the Great Recession. Now here's the key. It's about who holds these properties. And right now, a lot of it is held through third parties attached to your pension funds. I think it's absolutely disgusting. And that is why I want to lead a charge during this next crash in price. You're going to see a lot of big companies, a lot of big REITs, real estate investment trusts, a lot of syndication companies go completely. You're also going to see big managers like BlackRock, which I have to remind you, just gave back one of their prized possession towers back to the bank because they didn't even own it. Okay, they're all leveraged too. They're going to go down. And if you're not ready for this next crash, I don't know what to tell you. Now, going back to Arbor. Arbor's funding model was based heavily on CLOs, which allowed it to raise additional capital with which it could make these loans. A CLO is a debt instrument that allows lenders to get financing for commercial real estate loans by selling floating rate bonds to investors. Investors are paid when the borrowers make payments to the lenders. In this case, it's Arbor. So Arbor wasn't the only firm operating in this way. But as Bernard explained, they are the worst of the worst. The firm failed to diversify its loan book with around 90% exposure to multifamily. Now its delinquencies are on the rise. Now think about that. We have people, companies that have taken out multifamily loans, right? This is a multifamily property. Any property over 5 units or more are commercial multifamily property, and they're treated as commercial property. Higher rates, different loan terms, all right? We are seeing delinquencies rise, and because this company that we're talking about today, Arbor Realty, did not diversify the types of properties they're holding, because the industry is seeing an increase in delinquencies, they are now finding themselves in trouble, okay? It says so far, Arbor has been able to protect its CLO investors because only a part of its loan book is backed by CLO debt. CLO lenders can replace troubled debt in their CLO pool if it's in default or at imminent risk of default. They do this by buying out the debt in favor of investors and shifting healthier loans into the CLO pool. Bernard highlighted the practice of swapping loans within the CLO pool to maintain standards, describing it as moving deck chairs around the Titanic. This Titanic, while potentially shielding Arbor's immediate obligations to its investors, fails to address the underlying issues within the loan portfolio. Let me add something to that as well. See, investors are able to, at a certain point, let me give an example. There was a bank that we just recently saw that its stock has fallen like 60%. And it's just risen in the last couple of weeks because a pool of investors within the company decided to do a share buyback. So they bought shares to show strength. Here's the problem. When the investors run out of money or they see the writing on the wall and they stop buying the shares, that's when the music stops, right? When the ship is sinking. This is the exact same scenario. When you're moving around debt inside of a CLO to keep within your parameters that you've told your investors when you sent them the prospectus, there's only so much money to where you can try and save the sinking ship. And at a certain point, the bilge pumps are just there's not enough money that you could throw at it because eventually enough investors go, whoa, 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 what are we doing here? And I think that's what you're seeing in the banks and you're seeing in multifamily developments like this. The severity, it says, of Arbor's predicament becomes apparent when considering the potential consequences of CLO failure. If the CLO fails, again, collateralized loan obligation. It's an obligation that's collateralized by a piece of property, okay? It's a loan that's failing right now. It says, if the CLO fails and they get a 60% recovery, Arbor's recovery is 0 because it all goes to the bondholder. So you can see how Arbor is just going to be on the tip of the iceberg. Now, Arbor doesn't have anything to do with this company. I just wanted to stop by and show you. give you a visual. This is Halcyon Apartments, and we're in Reno, Nevada. But Reno has had such an explosion. Now think about this. In building, when this project was conceived a couple of years ago, they built it based off of the current interest rates and the current rentals out there, rent properties. But the problem is, Halcyon, they're not the only game in town. There are a lot of other companies building multifamily properties. And as more and more come online, you now have more competition to try it. It's harder to find tenants. That's when you go from high rents to low rents. And that's what a lot of millennials are finding right now, that it's cheaper to rent than to buy. And I don't blame them. That's really smart. As a matter of fact, a really neat way to judge what you should be doing in a real estate cycle is go and look at how much interest you can get by putting your money instead of on a property in, let's say, with a money market account or a bond, right? A short-term bond. And then you take into account the difference in the loan payment of what you'd be, all principal, interest, taxes, and insurance, or PITI. And then you consider you minus how much your rent is. You look at all of those factors and you go, you know what? It's cheaper to rent. As a matter of fact, most people, when they consider rent versus buying, all they do is simply compare the rent price, the monthly rent price, with the PITI. They don't even take into account, well, what if my down payment was making me 4, 5, maybe even 6% interest? That's another thing that you want to take into account. Now, I think that we're going to see some amazing opportunities in this state and states all over the country, because these properties were invested in with pension fund money, big money. And that means the bigger they are, the harder they fall. And I'm getting ready for it. I hope you guys are too. Hey, I hope you guys have a great day. Hello to everybody from Reno. If you're from Reno, hashtag Reno in this video. Hope you guys have a great day. The Economic Ninja, the Real Estate Ninja is out.